picture this scenario for a second. You've spent the last 20 years pouring just every ounce of your energy into building your business.
Yeah, sacrificing weekends, all the late nights.
Exactly. You've taken massive risks. And finally, you have accumulated real, tangible assets, like a successful company, maybe a beautiful family home, an investment property or two.
Right.
But what if I told you that, because of the way the paperwork is structured, a single unforeseen lawsuit from, say, a disgruntled supplier, or maybe a targeted SARS audit.
Or even just an economic downturn.
Yeah, an economic downturn that tanks your business. What if that could wipe out all of it? And I mean, not just the company, but your house, your kids' education fund, like everything.
Well, it's the ultimate nightmare for anyone who generates wealth.
Right.
You know, you spend decades meticulously building this castle, but you leave the front gate completely unlocked.
Yeah.
So when the financial storm hits, the damage doesn't just stop at the business doors. It floods right into your personal life.
And stopping that flood is basically the mission of today's deep dive. We are looking at a hidden superpower that's available specifically to South African business owners and investors. It's arguably the most robust defense mechanism you can build, which is the country's incredibly sophisticated trust system.
It genuinely rivals the leading financial centers of the world. And the best part is you don't even need like a complicated offshore setup in the Caribbean to access it.
Right, you don't have to fly to the Caymans.
Exactly. It's sitting right in our own backyard, provided you actually know how to operate the machinery.
Which is why we have a fantastic stack of sources to guide us through this machinery today. We're pulling from a really detailed legal newsletter that breaks down the structural framework of the South African Trust, from a strictly legal perspective. And to ground that theory in reality, we are combining it with the practical methodologies of Lumka Sturman. She's a dedicated trust consultant and asset protection specialist who works on the ground with entrepreneurs to actually implement these structures.
And that combination of, high-level legal theory and practical everyday application is just so crucial.
Yeah.
Because a trust is useless if it only works in a textbook. I mean, it has to withstand real-world pressure.
Okay, let's unpack this, because to understand why the South African trust system is such a strategic advantage today, we first have to understand the historical accident that actually created it.
Yeah, it really is a crazy accident of colonial history.
Totally. And it becomes glaringly obvious when you contrast South Africa with the rest of the African continent.
Right, because if you look at Africa's 54 countries, you basically find this patchwork quilt of legal systems, mostly determined by, who colonized them.
Right.
So let's look at the Francophone countries first, the ones that inherited civil law from French administration. Civil law is rooted in ancient Roman law, and its core principle regarding property is unitary ownership.
Meaning ownership is absolute, right? Like, you either own the apple or you don't. There is no middle ground.
Precisely. And because civil law demands that strict, singular definition of ownership, the very concept of a trust kind of breaks the system's brain.
Oh, because a trust splits it up.
Right. A trust fundamentally relies on splitting ownership into two parts. So because Francophone countries lack the legal vocabulary for that split, creating a trust there is historically very difficult.
But then you cross the border into Anglophone countries, which operate on English common law. And common law actually invented the trust. I remember reading about the origin of this. It goes all the way back to the Crusades, doesn't it?
It does, yeah.
Yeah.
Medieval knights were leaving England for years at a time to go fight. And they needed someone to manage their estates, collect rents, pay taxes while they were gone.
Right.
But they couldn't just hand over the deed to a friend, because if the friend decided, to just keep the land, the knight's family would be destitute.
The ultimate betrayal.
Exactly. So English courts developed this legal fiction. They split ownership.
Okay.
The trusted friend, the trustee, was given the legal title to manage the land. But the beneficial title, like the right to the profits and the ultimate use of the land, that remained locked in with the knight's family.
Okay, so we have Francophone Africa struggling with unitary ownership, and then Anglophone Africa using this medieval split ownership model. But South Africa has this completely unique hybrid.
Yes.
Because in the 17th century, Dutch settlers arrived at the Cape and brought Roman-Dutch private law, which is a civil system, just like the French one, absolute strict ownership.
But then history takes a sudden turn. In 1806, the British arrive and take over the Cape. And instead of entirely wiping out that rigorous Roman-Dutch legal system, the British just start injecting English commercial concepts into it to facilitate trade.
And then the biggest concept they brought over was the trust.
You got it.
It's basically like taking a highly flexible, agile British engine and dropping it into this really rigorous, sturdy Roman Dutch chassis. Like, you get the best of both worlds.
That hybrid nature is the secret sauce. It gives South African trusts incredible adaptability. But because it sits on a Roman Dutch foundation, it is policed by very strict legal certainty.
Wow.
And if you look elsewhere on the continent, you just don't find this balance. I mean, Mauritius has a robust trust framework, but it's almost entirely designed for offshore international wealth, not domestic operations.
Right. And a country like Botswana might have common law, but their economy is much smaller. And a smaller economy means a smaller legal profession, less historical case law, and just fewer specialists who have actually stress-tested complex trust arrangements in court.
Exactly. South Africa essentially sits in this Goldilocks zone. We have the economic size, the history, and this accidental legal masterpiece.
So we have this colonial-era Frankenstein of a legal system, right? How does that history actually translate into tools for you, the listener, to protect your hard-earned wealth today? The sources identify 5 specific pillars of trust sophistication in South Africa. So let's look at how the theory becomes a tangible asset.
Sure. So pillar 1 is the flexibility of trust types. Because of that hybrid history, you aren't forced into a one-size-fits-all box. The most common one is the discretionary trust. This is where the trustees hold all the cards. They have total discretion over if, when, and how much income is distributed to the beneficiaries.
Wait, if I'm the beneficiary, why would I want the trustee to have all the power? Doesn't that just leave me at their mercy?
It does, but that lack of power is exactly what protects you.
Oh, interesting.
Yeah, if a beneficiary has no legal right to demand the money, then the beneficiary's creditors also have no legal right to demand it. If you get sued personally, the person suing you cannot force the trust to pay out because the money isn't legally yours yet. It is the ultimate defensive shield.
Ah, so the separation is the defense. But what about the other types? The sources mention vesting trusts and something called a bewind trust.
Right, so a vesting trust is the opposite of discretionary. The beneficiary's rights are locked in. The trustee manages the assets, but the beneficiary has guaranteed right to the income. So it provides certainty, but you lose that protective shield against creditors. Then you have the bewind trust, which is uniquely South African. In a bewind trust, the beneficiary actually owns the property directly in their own name, but the trustee is appointed purely to administer it.
I can see how that would be useful for a minor or perhaps an adult who is incapacitated, you know? The wealth is entirely theirs, but the management is handled by an expert.
Exactly.
That brings us to Pillar 2, which is regulatory oversight. The Trust Property Control Act of 1988 mandates that every trust must be registered with the Master of the High Court, and no trustee can make a single move until the Master issues a formal letter of authority. Wait, isn't registering with the Master of the High Court just bureaucratic red tape that slows a business owner down? I mean, when you're trying to move fast and close deals, who wants to wait for a government department to issue a letter?
What's fascinating here is that the oversight is actually the source of the trust's power. By forcing you through this formal approval process, the government creates a public record.
Oh, I see.
Yeah, it prevents trusts from just being shady backroom agreements written on a napkin. When a South African trust deals with a third party, say you want to open a bank account or sign a commercial lease, that third party knows the trust is a legally valid, regulated entity. The red tape is the armor that proves your structure is legitimate.
It guarantees you aren't just making it up. And that legitimacy is supported by the final 3 pillars. Over a century of developed case law, a massive pool of professional expertise, and tight integration with the Income Tax Act and Estate Duty Act. We know exactly how judges will rule, we have the attorneys to build the structures, and we have a predictable map for how the taxman will view it.
Those pillars mean you aren't guessing. The road has been paved by 100 years of legal precedent.
So we have this sturdy, well-engineered fortress. But how do actual entrepreneurs use it on a daily basis? This brings us to the core philosophy of Lumke Sturman's methodology as an asset protection specialist. Her entire approach is built on one beautifully simple rule. Your trust owns the assets. Your company carries the risk.
If you take nothing else away from this discussion, remember that separation. To see how it works mechanically, let's dive into the first example from the sources, the Ndlovu family. They run a highly successful manufacturing business in Gauteng, generating about 80 million rand in annual turnover.
A massive operation, which means massive liability. Here's where it gets really interesting. Let's play out the scenario where they don't have a trust.
Okay.
If the founders hold all the shares in that manufacturing company in their personal names, all their accumulated wealth is tethered to the factory floor. If a piece of machinery fails, causes massive damage, and the company is sued into liquidation, those founders are going down with the ship. Creditors can pursue their personal estates to settle the business debts.
Furthermore, if the founders hold those shares personally and pass away, their estate is frozen. It has to go through the probate process, which can take years. The business might stall, and their heirs will be hit with hefty estate duty taxes and capital gains taxes just to inherit the shares.
But Lumka's methodology changes the board entirely. By setting up a family discretionary trust to hold the shares of the operating company, the Nlavu family completely severs the operational risk of the factory from the family's wealth.
Right.
If the factory goes bankrupt, the trust loses its shares in that specific company, but the family's other assets, which are also owned by the trust, remain untouchable.
And on the succession side, a trust does not die. When the founders pass away, the trust continues to hold the shares. There is no estate duty triggered on the shares, no capital gains tax on death, and no frozen assets. The business continues operating the next morning without missing a beat.
It is an institutional structure that outlasts a human lifespan. But asset protection is really only half the equation, right? The other half is tax efficiency. Let's look at the second example. Mrs. Okonkwo's property portfolio. She holds 45 million rand in commercial property. Now, trusts in South Africa have a reputation for being heavily taxed.
They do, yeah.
They face a flat 45% income tax rate and an effective capital gains tax rate of 36%. On paper, putting profit-generating property into a trust sounds like financial suicide.
Well, if you retain the rental income inside the trust, it is punitive. SARS taxes trusts heavily to discourage people from using them merely as tax avoidance vaults. But Mrs. Okonkwo uses a mechanism known as the conduit principle, or a conditional vesting structure.
Let's break down how that actually works, because this is where the magic happens.
Under the conduit principle, the trust acts like a pipe rather than a bucket. When the trust receives, let's say, 100,000 rand in rental income, the trustees can immediately distribute that money to the beneficiaries, perhaps Mrs. Okonkwo's university-aged children.
Okay.
Because the money flows straight through the trust to the beneficiaries in the same tax year, it retains its nature as rental income.
And here's the crucial part. It is then taxed in the hands of the children at their individual tax rates. If those children have no other income, they fall into a much lower tax bracket, maybe 18%, or even 0% if it's below the threshold.
Exactly. Instead of the trust paying 45,000 rand to SARS, the family might pay 18,000 rand, legally keeping 27,000 rand inside the family unit.
Wow.
But, and this is a big but, the trustees must exercise genuine discretion and follow strict accounting rules to prove the money actually moved.
Which fundamentally changes how you should view a trust. It isn't just a static vault where you lock away your title deeds and forget about them. It is an active, dynamic operating system for your family's wealth. It manages risk, it distributes income efficiently, and it plans for the next generation.
But that dynamic nature requires active maintenance. You cannot set it up once and put the paperwork in a drawer for a decade.
And that leads to the obvious question. If these structures are so powerful and South Africa has this world-class system, why do so many business owners end up getting it wrong?
Because the legal landscape is not static. It shifts. And having a poorly maintained trust gives you a false sense of security, which is arguably worse than having no trust at all.
Yeah.
You think you are protected, but you're just standing behind a paper wall.
The sources highlight the Section 7C revolution of 2017 as the perfect example of the shifting landscape. This completely caught people off guard.
It was a massive shakeup by SARS. Prior to 2017, a widespread strategy was for a wealthy individual to lend money or sell assets to their trust on an interest-free loan account.
So if I had 10 million rand, I would just lend it to my trust at 0% interest. The 10 million grows inside the trust, safe from my creditors, and outside of my estate for tax purposes. It was a massive loophole.
Right, and SARS realized they were bleeding tax revenue through this loophole. So they introduced Section 7C. They changed the rules overnight. They said if you lend money to a trust, you must charge a market-related interest rate, specifically the repo rate plus 1%.
And if I refuse? Like if I just keep my loan at 0%?
Then SARS applies what is called a deemed donations tax on foregone interest.
A deemed donations tax?
Yeah. They look at the interest you should have charged, say, 8%, And they treat that phantom money as if you gifted it to the trust. They will then tax you 20% on that phantom amount every single year.
So overnight, thousands of trusts that were perfectly compliant in 2016 suddenly became massive tax liabilities in 2017. If you didn't have a professional reviewing your structure and restructuring your loans, you were hemorrhaging money without even knowing it.
And beyond tax law changes, the biggest operational risk is creating a sham trust.
Ah, this is the alter ego problem, right?
Yeah,
This is when an entrepreneur sets up a trust, registers it with the master, but in their day-to-day life, they just treat the trust's bank account like their own personal ATM.
exactly.
They use the trust debit card to buy groceries. They sign personal guarantees for business loans using trust assets. They never hold trustee meetings or minute their decisions.
If we connect this to the bigger picture, the law requires a strict separation of control. If you get sued, and a forensic accountant proves that you treated the trust assets as your own personal piggy bank, a judge will look right past the paperwork.
They'll just ignore it.
Yep. The court will pierce the corporate veil, declare the trust a sham, and seize the assets to pay your personal creditors.
You just cannot have it both ways. You cannot claim it's a separate, untouchable entity when the liquidators come knocking, but treat it like your own back pocket the rest of the time.
Which is precisely why trying to DIY a trust structure is a recipe for catastrophic failure. You need an architect to build the fortress and a warden to maintain it.
And that is the exact gap Lumka Sturman fills. Her methodology isn't about selling you a generic trust deed template downloaded from the internet. It's about actively auditing the relationship between your personal life, your business exposure, and your assets.
Yeah, if you look at her approach, it's highly diagnostic. For instance, she conducts a foundation audit, which costs R$25,970. This isn't just paperwork she gets under the hood of your life.
Right. She looks at where you might have unwittingly signed personal sureties for your business lease. She identifies where your personal wealth is bleeding into operational risk.
Because you have to find the cracks in the foundation before you can build the walls. Once the risks are identified, she moves to the Asset Protection Blueprint, which is R$39,990. This is the architectural phase. She maps out exactly how the money and assets should flow between your operating company, a holding company, and the trust to ensure you are legally compliant and tax efficient.
And perhaps the most vital service she provides is the annual Fortress checkup. Because, as we saw with Section 7C, the law will change. Your family dynamics will change. You might buy new businesses. Someone needs to draft the annual resolutions, update the compliance, and catch the red flags before SARS or a creditor does. She basically acts as the chief risk officer for your personal wealth. Look, if you are out there right now generating income, if you are holding valuable property, company shares, or significant cash in your own personal name, you are carrying a massive amount of unnecessary risk. You are walking around with the castle gates wide open. I highly recommend you visit www.lumkosterman.com. That is www.lumkosterman.com. It is incredibly informative, and it's really the first step in separating your ownership from your liability.
The overarching lesson from these sources is that South Africa has handed its entrepreneurs a globally competitive shield. You have the legal framework, you have the historical case law, and you have experts like Lumka to guide you. You just have to make the decision to use it properly.
So what does this all mean? Ultimately, it forces us to realize that wealth building is only the first half of the journey. You can be a brilliant innovator, you can outwork your competitors, and you can build a massive balance sheet. But wealth preservation is an entirely different skill set. If you ignore preservation, you are risking everything you've built.
Making money requires risk. Keeping money requires removing risk.
I love that distinction. Before we wrap up today's deep dive, I want to leave you with one final thought to mull over. We have spent this entire conversation talking about using a trust to protect your wealth from outside threats, right? Like creditors, lawsuits, liquidations, changes in tax law.
The external barbarians at the gate.
Yes. But what happens when the greatest risk to your legacy comes from inside the house? How do you design a trust deed that protects a beneficiary from their own worst habits? Whether that is reckless spending, a struggle with addiction, or just terrible financial judgment, how do you protect the family wealth from a family member without resorting to ruling from the grave?
Navigating that human element is where the true art of trust drafting begins.
It is the ultimate puzzle. Food for thought. Until next time, keep digging, keep learning, and make sure your castle is actually a fortress.